Wall Street is convinced that OpenAI and Anthropic are going to completely kill off your entire software industry, but they are missing a structural reality, which is that intelligence is becoming commoditized, but distribution is still king. So while everyone is panicking about your LLM stealing the lunches of your enterprise software companies, I think the reality is that your frontier AI models are getting cheaper, faster, and more commoditized by the day. So in this video, we'll be breaking down Microsoft's divorce from OpenAI as well as their disassociation, a sector that I find interesting today, a country that is trading at an attractive valuation, and Meta's plans on turning into a cloud-based company. Okay, so let's start off with Microsoft stock. So this is our Substack. Feel free to check it out if you're interested. It's the link in the description below. We post write-ups on companies as well as deep dives. So we'll start off with Microsoft today. This is from Fiscal AI. So Microsoft is up around 7% over the past 5 days. So with the entire software space has been going up. So I had a discussion the other day at my firm currently, and we were sort of like debating on the entire software and AI debacle. And the counter to my point was that software is dying because the likes of your Anthropic, your Gemini, your OpenAI are currently stealing the lunches of all these different software companies because they need to raise money. They either raise money by being more profitable, by stealing away your lunches of your software companies, or they raise debt. Those are the two different options that you can take. So his view is that the LLMs will have to drastically increase their profitability, and the only way for them to do so is to go and sort of like take away your share from all your software companies. So I played devil's advocate, of course, and I took the opposing stance. And my point currently is that what if AI is commoditized? What if intelligence becomes a commodity rather than a scarcity? We have already seen how your Chinese companies have been able to do so much with so little. So currently they don't have the advanced chips yet. But if you look at the leaderboards, the Quen model by Alibaba is actually up there as well with your other frontier models from the US. So if AI is commoditized, then wouldn't that mean that your software companies with the distribution will benefit? Wouldn't the incumbents benefit? That was my point. So coming back to Microsoft, the stock has unreasonably sold off due to AI fears. And my view is that management's active disassociation with OpenAI is a great move. Because OpenAI, in my view, is a weak business unless they pivot away from consumer to enterprise. Currently, if you look at their financials, they have around 82% of revenue coming from consumer. They're planning to change it to 53% by consumers by 2030. So they're expecting their enterprise solutions to explode here on out. So consumers won't have the stickiness that your enterprises have. And when options are vast, switching costs will naturally go down. And there's another point here that I would like to highlight from Microsoft. So there was a narrative going around after the earnings report that OpenAI actually made up a large chunk of the entire Microsoft backlog. But if you look at the backlog numbers here, if you were to compare it to the likes of Alphabet, Amazon, Oracle, if you were to remove both the OpenAI as well as Anthropic backlog, Microsoft currently has the highest backlog, the most diversified backlog outside of OpenAI as well as Anthropic. So I haven't seen this narrative being pushed online yet, and we'll have to see, but my view is that the risk to reward for Microsoft is currently attractive. It is the cheapest Mac 7 company behind Meta right now, and if you were to place a bet on a Mac 7 company, I think Microsoft is one that is attractive today. Okay, next piece of news that I'll be covering is on Mark Zuckerberg's plans to turn Meta into a cloud business. So over here, this article said that Mark Zuckerberg says a Meta cloud computing business is definitely on the table. So he mentioned that Meta could enter the cloud computing market if it overspends on data center and has excess capacity. He said it's definitely on the table during the meeting. And of course, of the 4 hyperscalers, Meta is the only company that doesn't sell their cloud infrastructure and services. So my thoughts here are there are 2 different ways for you to interpret this. First of all is that he probably already overbuilt. So he's overbuilt already and he's hinting to the markets that Meta is trying to pivot this way. And then second of all is that he's trying to calm the markets because the markets have been selling the stock off because Meta doesn't have a cloud service that is growing backlogs at 100%, for instance. So he's trying to calm the markets. He's trying to say that, oh, the capex spend today is justified. Even if we overspend, we have a backdoor that we can take on. So my thoughts are this. If they plan to switch to a cloud business, is a risk to the other cloud businesses in the space. So the likes of your Amazon, your Azure from Microsoft, as well as your GCP from Google. And second of all, it is a threat to their existing business as well. Why is that so? First of all, it hurts the margins. The margins for the businesses are incredible right now. The advertising business currently is an amazing business model. And second of all is that it lowers the margins for your other companies as well in the space. It signals that it is getting commoditized and sort of like a race to the bottom. And that wouldn't be good for the entire cloud computing space. Third of all, it's a sign that they have overbuilt as well. So if they have overbuilt, then yeah, imagine the scale of your other cloud computing companies as well. So I think it's a worry if Meta changes their business model to a cloud computing one. I think the business that they currently have is great. Hopefully they stick to it. If they switch the model, then yes, it's time to think about my position for Meta. Okay, next portion, let's talk about a country that is interesting right now. So China. China companies have sold off again this week with massive outflows from our Chinese ETFs. So your Queb, all your Chinese companies have been selling off quite strongly throughout the week. And while I don't think the bottom is in yet, some of the companies are interesting from a valuation and fundamental standpoint. So this is Pinduoduo. Pinduoduo is currently down around 7% over the past 5 days. I believe it's trading at an EV to EBIT of 5 times with around half of its market cap in cash. It's quite crazy. Baba is trading at 15 times forward price to earnings, and these two companies in particular are interesting. So I'll talk about Alibaba first. I think I spoke about this one last week as well. But in short, the thesis is this. First of all is margin improvement tied to reduction in quick commerce losses, dragging EBITDA by 40%. So if you look at their earnings report and what they said on the last earnings call, quick commerce was actually the one that dragged a lot of their EBITDA. If you were to remove the entire quick commerce segment, and the business actually had a mid-single digit growth for EBITDA for their e-commerce segment. And in this quick commerce space, the government has actually stepped in as well. So the government actually came in to regulate this space to stop all these companies, Meituan, JD as well as Baba, from giving free food to people. Because if you give your free food to the people, then of course your mom and pop shops, they will suffer. And then there's deflationary pressures as well. So that's a positive for the quick commerce business. Management actually said that they expect this business to turn unit economic positive by the end of, I believe, next year. So the start of next year. And then second of all is that the Ali Cloud business is growing quite strong as well. So they're projecting around 40% growth for their Ali Cloud business. And they have been increasing prices as well. So in the past, there was a cloud computing price war again. It's a Chinese tradition to have your price wars. But currently, they're increasing prices on their cloud businesses, which I think is a positive. And then they're expanding their TAM as well through their Quen model. And overall, I'm positive on Alibaba. And then second of all, it's Pinduoduo. So Pinduoduo is a business that is just really cheap. So it's 5 times EV to EBITDA. But I'm a little confused by the management team's refusal to return capital to your shareholders through buybacks as well as dividends. So the management have expressed their reluctance since, I believe, around 2024. And I thought that Lilu's involvement in the business, Lilu's investment into Pinduoduo would have unlocked some value for shareholders through the buybacks. But it hasn't materialized yet. But nonetheless, it's super cheap. Their funds are currently mostly outside of China, so the cash that they hold can be used for buybacks. But they haven't returned capital yet, and it doesn't seem like they're going to do that anytime soon. So yeah, these two companies are interesting. I think investors will continually exit your Chinese companies and chase your AI companies elsewhere in Korea as well as in Japan. But value is there. Should this sell-off continue? Last part, let's talk about a sector. So this is Steve Eisman's video. If you guys haven't checked it out, I suggest you go and check it out. It's an interesting video with an analyst. So Steve Eisman, he actually did an interview with an aerospace and defense analyst. And it was a great watch. My thought process before watching the video was as follows. So number one, of course, you have the Iran war, and the Iran war naturally leads to the need for restocking. And second of all is that there'll be further defense spending because of overall geopolitical instability. But there was another element that he mentioned as well tied to the lack of inventory going up to the war. So besides the restocking, there's actually lack of inventory. So there's a lot more restocking needed. It has been sort of exacerbated by your Iran war, which could fuel the next wave of defense spending. So defense companies are structurally shifting over from a pure fixed cost contract to sort of like a contract that is fixed cost plus some inflation escalators. So if you look back in the past, I think the government in the US, they strictly stuck to a pure fixed price model, which was bad for your defense companies because there's inflation in the parts and of course they have to take in all the costs. A lot of the contracts were actually loss making. So Airbus had a few contracts that were loss making. I think Northrop as well. Lockheed Martin as well. But currently they're switching this model around and the companies are clearing all their unprofitable backlogs soon. So you will likely see margin expansion coming up once they clear it off. These companies have great visibility, great predictability, and probably have strong businesses that you can find without disruption. Of course, unless an idiot runs the business. So another thing to note is this. I know your oil prices have gone up. When your oil prices go up, then what happens is that your commercial aerospace division will sell off because there's lowered flights because of higher ticket prices. And of course, we had this air travel outlook that was sort of like guided down by GE Aerospace. And your aerospace and defense ETF is close to sort of like a bear market as well, before there was resolution to the Iran war. This was actually one of the ideas that we discussed internally, but there are actually structural tailwinds in your air travel and defense industry as a whole. So we'll talk about air travel first. This is with regards to commercial aviation. Commercial aviation has grown at 1.5 times GDP. So as you can see over here, there's a discrepancy between your GDP growth, your defense spending growth, as well as your passenger revenue. So even defense growth has grown a lot faster than your GDP growth as a whole. And second of all is this. So besides your commercial aviation growth, maybe let's focus on your defense spending. I think there was this new policy that was put forward by NATO as well, which is that they're planning to increase their defense spending from 2% GDP baseline to 5% GDP by 2035. So this represents an aggressive long-term growth opportunity for a lot of your defense companies with exposure to NATO. I believe in the US, they have this restocking problem as well, which was highlighted in Steve Eisman's video. So likewise, they have to spend money, and you have your contracts that are shifting over from fixed costs to escalators. And overall, I think this space is one that is really interesting with minimal disruption. So yeah, it's one that I'm currently tracking. Hopefully it continually sells off. And one more thing, if you guys stayed on this backdrop, I actually added a small position into booking last week. I'll release a write-up on Substack soon. Feel free to check it out if you're interested. I hope you guys have found this video useful, and I'll see you soon.